Hey everyone, welcome to the 5th episode of the Market 0 to End series. This one is extremely important, and this one is about the power of being retail. So a lot of people will say things like, Warren Buffett hasn't beat the market in the last 20 years. Why do you think you can do it? Or X number of mutual fund managers or X percent of hedge fund managers don't beat the market. Why do you think you can do it? These guys have money, better information, they have quants, they have scientists, they have anything money can buy. So why on earth do you think you can succeed and do something they can't? So this is what this video is really about. So this video is called The Power of Being Retail, but I first want to talk about the disadvantages. And most people know these are pretty obvious. But essentially, no information. You're the last to know everything. Institutions might be calling management. They have these so-called channel checks. They have the best data. Maybe they have Bloomberg Terminal, something like that. They might even be the one crafting some of the news in certain ways. The next disadvantage you have is execution. And why I say this, for example, a popular brokerage like Robinhood sells your data so you can easily be front run. So you might get worse fills and stuff like that. Now, the emotional risk. This is a big one because emotion is huge in trading. You might make a bad decision when you're down and sell, whereas if you're like a hedge fund or a mutual fund, you might not care at all. It's not even your money. If I lost $1 billion of other people's money, I might not even feel that bad. If I lost $1 million of my own, I'd feel a deep pain. So there's that disadvantage. Now, I kind of got into this earlier, but you have no team. The fact of the matter is that a hedge fund, I might call a quant, which is some genius math Olympiad, and say, hey, can you look into this for me? But as a retail trader, you have nothing but yourself and perhaps some friends, whether that's in person or online. And don't get me wrong, you can do research, but it's not like you have a dedicated team, you know? So it's definitely different. And limited tools, that kind of ties in with earlier as well. Like you probably don't have 50,000 per year to drop on Bloomberg. So while other people are getting that info right away, you're probably not. The sites you might be using to get something as basic as, say, a PE ratio might not be that accurate. It might give you an adjusted PE and just be inconsistent because you don't have the right tools. And another thing is you can't move markets. Now, when you have huge size, you can move the markets. That's not the only advantage. Sometimes these big guys have such a good reputation. You see Warren Buffett buys a stock, boom, it's up after hours the same day. That is pretty small, but the big ones really are that a lot of times certain shops, maybe like a short selling firm, will release their short report and boom, the stock's down 20%. How easy is that? They don't even need to be right about it. I mean, I've seen plenty of times short reports are completely wrong, but they probably make a huge chunk of change just by releasing their thing and getting short or long puts before that. So another thing, and this is a huge one really, a disadvantage for retail, is the distractions. A guy running their hedge fund only worries about their hedge fund. That's their job. You as a retail trader, everybody's different. But you might have a job that you have just during the day, and it might overlap with the working hours. You might be a student taking your classes. It's a much different game. You can't stare at the screen 24/7 likely, whereas a hedge fund manager, you likely can for the most part. So now, talk about the advantages and why we actually can win. And I do believe these advantages are actually better and outweigh the disadvantages. So number one is the flexibility. If you want to go all in a single stock, instantly you can. You change your mind 2 seconds later, you can do that too. Institutions might not be able to do that. You have that flexibility. With institutions, you got benchmarks, right? People might start withdrawing their money if you're not beating the S&P. you could sit patiently, go on vacation, do whatever you want, and come and trade whenever you want. So that is one of your advantages, flexibility. And a lot of times having that flexibility means you don't need to be limited by others. Now, a big thing here is creativity. And it's kind of an interesting point, but essentially the idea is that you are able to think independently, and that aligns with flexibility, but you don't have to have institutional constraints. So you might be able to go super unpopular ideas, not worrying about your clients and such, and it allows you to explore creative things, and some funds are limited to a certain size or maybe a certain country's assets. With you can do something that's on the over-the-counter markets. You can be on the Israel exchange, the Hong Kong exchange. You can do whatever you want, really. So that allows you to really explore the creativity. And it is very similar to freedom, but in some ways a little bit different. So, and then once again with freedom, you just don't really have that pressure to perform, and you do whatever you want. So you can really look about asymmetrical things. And another thing about, about being a fund manager, for example, you might be worried about like ethical investments, stuff like that. Whereas when you're yourself, you can really do whatever you want. So once again, nothing potentially capping your gains. And then number 4 is growth. And typically I mean personal growth, because with institutions, you lose someone else's money, you don't care, and you make a good chunk of change, you collect your fees. Just the structure almost promotes a gambling mentality, because you lose nothing, you win big. When you're using your own money, it's really you have to win to succeed. You can't afford to dilly-dally and lose all your money. So with that being said, each lesson allows you to grow and to get better. And then the next one would be the lack of limits. And once again, it ties in with freedom, creativity, flexibility, pretty similar. But just to reiterate it, really it is very simple. You can do whatever you want. You can trade futures, you can trade options, you can be trying to buy IPOs, you can buy microcaps, over-the-counter stocks, you can be on any exchange you want, right? So you can just do anything and everything, and that is a huge advantage. Now, number 6, this is pretty important, the not front-running yourself portion. And when you're entering and exiting, for the most part, you're not really worried about affecting the price. Like if you're on a super microcap stock and you have a decent chunk of change, you do need to kind of enter in a slower manner. But for the most part, like if I go buy Apple, I don't even care. Like I can use a market order. I don't need to worry about a single thing, right? Whereas someone like Warren Buffett, even though Apple's very liquid, he still needs to care to an extent when he's entering and exiting. And me, I can go buy a tiny stock in the Russell 3000, and someone like Warren Buffett would just move it too much. So it's really nice that you're not front running yourself. You're not pushing the price up when you're entering and making it worse for your next entries and exits. For the most part, you just don't worry at all. And this is an extremely, extremely big advantage on smaller names. And once again, this kind of ties in with the last point that you are small, so you can do moves quickly, easily. Don't worry about liquidity. Institutions, for the most part, are mandated to a certain market cap level. You can front run them because, maybe they can only buy this company above 1 billion market cap and they want to, but they just can't, right? And you're there when it's at 500 million market cap. So you can front run them a lot of times just by being small, being able to do things that they can't do, whether it's because they're going to move the price or just because they're not allowed by the rules. But yeah, essentially like these advantages in like the disadvantage ties into the advantage, everything's related. But ultimately speaking, it's a very different game but you can get an edge. So when someone tells you, oh, Warren Buffett couldn't beat the market in the last 20 years, why can you? I mean, there's plenty of answers to that, and I don't think such a poor comparison should prevent you from trying to beat the market, because it's certainly possible, and I believe it's actually easy.